Welcome to What's Not Priced In, a weekly investor podcast by Fat Tail Investment Research. In a world of confusion and rapid change, experts Kirill Prakapenka and Greg Canavan look behind the headlines to unveil the hidden opportunities within the Australian stock market. Now, let's dive into today's episode.
This week, we didn't talk about AI, but we did talk about the limits of monetary policy, whether coal stocks are attractive or present a value trap, the risk of the market not pricing in a hit to corporate earnings, Greg's charts of the week, and why commodities are still appealing on a long-term basis. Hello, and welcome back to the second episode of What's Not Priced In, where Greg and I explore what the market has already discounted, but more importantly, what it hasn't yet. Now, this podcast is driven by one overarching question, a question we'll keep asking over and over again, and that question is this already priced in? Now, a story may be interesting, a story may be trending, but the right question to ask is whether the story's implications are already being priced in by the market. Has the market already incorporated the story? For example, AI is taking over the world. That's an interesting story, but move on. It's already priced in. Nvidia is the hottest stock in the world right now. Forget about it. Ship's already sailed. That said, each week we'd like to start by sort of quickly reviewing the stories that we found interesting. And when we talk about those stories, we'll have the one question firmly in mind, is this already priced in? But also, what's the market overlooking? Now, with that said, I'll turn to Greg. Greg, welcome.
Kirill, g'day, mate. And it's a really good point you make, I think. One of the things that I always try to focus on when I'm reading the financial pages, when I'm looking at the headlines, is what does this mean for the pricing of the securities that are involved? And it takes some time to get used to it, but eventually when you start to recognize trends or the way that sentiment is expressed in articles, in headlines, then you get a better sense of, yes, this is all bad news, this is all horrible, but it's in the price and therefore there's quite potentially an opportunity, because what's not priced in is the flip side of things perhaps not being bad as expected. Yeah. Or in the case of NVIDIA and AI that you just mentioned, what's not priced in is perhaps a return to reality and rational thinking, in that, yes, there might be some competitive threats that come down the track and erode some of those big gains that are being priced in. So really good intro, mate, because the whole point of this is to sort of ask what's priced in, what's not priced in, and get people looking at areas that may be a little more overlooked, and that tends to be where the opportunities are.
Yeah, it's also the most interesting part of the market anyway. The most fertile ideas probably come where the market isn't looking, or where the market has sort of mispriced some things. But I guess I'll start with you, and I want to ask you, what have been the biggest stories in your mind? What have you been looking at this week?
I think the biggest story from my perspective has been the macro story and of inflation and interest rates in Australia. The inflation numbers came out midweek, suggesting that inflation is picking up a little bit. I know the underlying number continued to fall, but the headline number, and as you pointed out to me during the week, the trimmed mean number that the RBA looks at did pick up, which turned the market into thinking there wouldn't be a rate rise in June, which is next on Tuesday, to increasing the chance of a rate rise. So it's gone from almost 0% chance of a rate rise to around, when I looked at it early this morning, the market was predicting about a 22% chance of a rate rise, which still suggests the probability is that they'll stay on hold. But the market reaction, I thought, was quite telling. And the ASX 200, the banks, they all dropped quite sharply. And when I look at the yield curve, the yield curve, which is the difference between the 2-year bond yield and the 10-year bond yield, that has now come down to just under 2 basis points. So it's effectively a flat yield curve and very near on the cusp of inverting. And most listeners will probably know that an inverted yield curve is the bond market's way of saying, look, the economy is slowing sharply and it's starting to price in a recession, because it's not usual for a 2-year bond yield to be higher than a 10-year bond yield. So it's really the longer term bond yield saying the economy is going to slow, inflation is going to come out of the economy, and quite possibly there'll be a recession. So if you look at the yield curve 6 months ago, the difference between the 2 and the 10-year was nearly 50 basis points, and it's now come down to being flat. So bringing that back to the biggest story of the week, I think the market's saying to the RBA, if you continue to raise rates, it's really going to start hurting.
Yeah.
It's really going to, because the economy is already slowing. And one thing that we often talk about is the lagged effect of monetary policy, and those lags are still going to play out this year. So even if the RBA stays on hold, from here, you're still going to get the lagged impact of last year's and early this year's rate rises coming through for the remainder of the year. So I think, the market was saying if you continue to raise rates, it is really going to start hurting. The banks, the ASX 200 bank index fell about 6.5% throughout the month of May. So clearly the banks are adjusting to this slower economic environment and the outlook for weaker economic growth. And I think the other thing to bring into that is the news that house prices are rising again.
Yeah.
And there's a certain element of the market that thinks, okay, the RBA has to slow this down. But anyone who's looked at the Aussie housing market or been involved with it for a while, knows that monetary policy has a certain amount of impact, but it's really more to do with the lack of supply. Yeah. And we've got a really terrible structural situation in the Aussie housing market at the moment. We need a lot more supply. Builders are going out of business, record bankruptcies over the past few months. Costs are rising massively. So anyone on a fixed price contract that they entered into cannot meet those commitments and is going out of business. So, supply is a massive issue, and that's just on the building side. And then you've got the permitting and the approvals. And a lot of that's handled by local governments. And to be honest, local governments are not, try and put this nicely, they're not in the position to manage Australia's housing supply crisis. I might just leave it there.
Well, I think you did mention supply, and I think Philip Lowe of the RBA, he was at a budget estimates hearing, I think yesterday, and he did mention supply was a big issue when he was prodded by the senators about the rental crisis and also the rising house prices. And I think he gets a lot of flack, but I think in this instance he was saying there's so much that the RBA can do. It's sort of restricted to monetary policy. And he was saying if you do want to fix rental crisis, if you want to fix the ballooning house prices, you just sort of have to focus on supply instead of necessarily what Philip Lowe is doing in Sydney.
Yeah, I think it's a couple of things. Politicians generally outsource a lot of stuff to the RBA, and to my mind, housing is such a huge problem that goes across all levels of government that no one really knows how to solve it. So they're just saying, look, the RBA, that's your domain. Can you fix that? And going back to what I mentioned earlier, if the market thinks that the RBA has to solve the housing problem, then interest rates are going to continue going up.
Yeah.
That's not going to fix anything. It's just going to push the economy into a bigger hole. So, perhaps that was part of Wednesday's sell-off reaction as well, when the news of rising house prices came out along with the rising inflation. And then you throw in the fact that energy prices are going up by 20% across the board starting next month, which is going to feed into further inflation. So similar to what we mentioned last week about what's not priced in, it's the fact that central banks will probably have to stay on hold for much longer than expected, and will have even if you see a slowing in the economy, they're going to have less width to cut interest rates. And in the past, when inflation wasn't sticky and inflation wasn't a problem, they could pivot pretty quickly and reduce interest rates and get the monetary liquidity flowing back into the system. But this time around, it's not going to happen. So that's going to continue to be a headwind for prices for some time, I think.
Yeah. Well, I have a question. What do you think is the peak in interest rates for Australia? Do you think we've sort of hit the peak, or is there some more to go?
If I had to guess, I'd say the probability suggests we'd probably be on hold from here. If you look at those indicators coming from the bond market, which says the Aussie economy is slowing quite sharply, the RBA would have to be looking at that, you would think, and say, well, because they have acknowledged that monetary policy acts with a lag, and they have acknowledged that they need to sit back and wait and see. Of course, that all depends on further inflationary readings. But one of the ironies of higher inflation is when things like energy and fuel costs come through and push inflation up. Often that's a supply side issue, and the Reserve Bank manages the demand side. So by crushing demand and not sorting out supply, which is the same as in the housing market, you're just making things worse. So, and this is where it comes down to, we just don't have competent governments anymore. We don't have, on both sides of the political aisle, we've just got, really incompetent bureaucrats who are not interested in genuine reform. If you look at, all the spending that's going on in the fiscal budget that came out a couple of months ago, it's huge amounts of spending, no real reform, and that's not really going to fix anything. So if the RBA stays on, doesn't raise rates further, then, as I said, I think they'll be hamstrung in trying to reduce rates, even though you're going to get signs of an economic slowdown. And just looking at the banks, you can tell there's a slowdown going on. Consumer discretionary stocks have all started to break down from a charting perspective. They were looking reasonably good a couple of months ago, and just in this past month, they've really started to hurt. And maybe partly that's because these fixed rates are starting to roll off, and we're starting to see people on fixed rate mortgages move into the variable rate, which is really hurting their incomes. So that's a big thing. You pointed out last week that students are getting smashed on their HECS because of the high inflation rates. So I think all these things are starting to flow through and really have an impact on people's ability to spend, and that's going to have a big impact. And then you throw in falling iron ore and coal prices, natural gas prices, which have been very beneficial for the trade situation. There's a lot of headwinds at the moment.
Yeah, definitely, and we'll get into the commodities later on into the episode. Yes. I think from my end, I think story of the week, and it's sort of been a story I think for the last maybe few weeks or maybe a few months. Anyway, and before I get into the story, I'll just start off with this investor called Bob Farrell. Maybe some viewers have heard of him, maybe not. And he studied under Ben Graham and David Dodd, and they're obviously the authors of Security Analysis, something they're the fathers of value investing. Anyway, he was on Wall Street for decades, and he sort of distilled his experience into these 10 rules of investing. And the rule that I want to talk about is the 7th rule, and it says that markets are strongest when they are broad and weakest when they narrow to a handful of blue chip names. Now, that definitely sounds familiar for anyone who's listening, because especially in the US, it's been dominated by a handful of blue chip names, and you can literally a handful. It's like you can count it on two hands. For example, the S&P 500, which is up about 10% this year, would actually be down for the year without the contribution of only 8 of the largest 10 tech stocks. So I think that's the story for me. I just find it quite fascinating that the tech rally has been so prominent, but it's been so concentrated, so condensed to just a tiny amount of stocks. And so I sort of want to ask you, is this a bad thing? Is this a bad omen? Or is this just something normal that, indexes, just the way that they compose, they usually are going to be dominated by the largest companies?
I think if you're a passive investor investing in the S&P 500 or the NASDAQ and you just want to get access to an index that's going up, I think it's probably bad news. I think if you're a stock picker, it doesn't really matter. And this is where having this discussion is really interesting, because you can point to all these things and say, okay, well, the bond market's pricing in a slowdown, commodity prices are coming off. under the surface, a lot of stocks have already priced in a lot of bad news, and there is a bear market going on for a lot of stocks underneath the surface. But because capital has concentrated into these largest names, the indexes aren't really reflecting the underlying weakness. So if you're a stock picker, there's a lot of really good value stocks out there. I'm not saying it's, the depths of a bear market, but there's plenty of opportunities that you can look at and say, okay, well, that's a reasonable price to pay. We're not talking about, 2000 level valuations where everything was crazy and it was just really difficult to find good value stocks. So, from that perspective, I don't think the market is all that mispriced. There are, and especially in Australia, there are mispricings, obviously, in the US, and we've got some charts to show a little bit later that shows the divergence between the headline indices and the internals of the market, which I think is going to be quite interesting to look at. But I think there's good opportunities underlying the market, and sometimes if you focus too much just on the indices, then you're going to miss those opportunities, because you might say to yourself, come back and wake me up when the market falls 30%, which is fine. But at that point, you might see capital recycle into these undervalued names from the big caps, which will push them up. And then the big caps just come back down to a fair value. And yes, the index might be down a bit, but you could have had the opportunity to outperform that index by, looking at names now. So yeah, it's a difficult thing to communicate, because the index doesn't represent all the stocks in the market. Well, it does represent the stocks, but it doesn't paint the picture of every stock. So I think for a stock picking market, this is a pretty good one.
Yeah, and I think I'm always reminded of something that you've said. It's not, don't think of it as a stock market. It's a market of stocks. So there will always be opportunities. You don't have to be like, oh, the macroeconomics are bad, I'm just going to not invest for a year and wait for things to get better. There's always going to be opportunities out there if you're a skilled stock picker.
Absolutely. And I think one of the things, sorry, I was just going to say, one of the things that I'm focusing more on now is buying undervalued stocks that have got healthy dividend yields, because, the market may struggle for another 6 months. It may struggle for another 12 months. But if you're getting a healthy income stream while you're waiting for that re-rate, then, that's in my mind, that's a better long-term strategy than sitting in cash. Of course, cash has got optionality value. If you keep a portion of your portfolio in cash and wait for those opportunities, that's fine. I'm certainly doing that in my own super fund. But in terms of being out of the market 100%, waiting for that index to fall, whatever your magic number is, I think that's probably a pretty tricky or a dangerous strategy to follow.
Yeah. Well, you mentioned dividend stocks and dividend yields, and I think now I want to turn to our stocks of the week segment. And there are some doozy high dividend yields that we're going to talk about. Yep. So the stocks of the week are going to be a sector, and it's going to be coal stocks. And I'll just basically give a brief rundown of the performance of a couple, just to give an example. So for Whitehaven Coal is down about 35% year to date. Its trailing dividend yield is about 12%, and its trailing PE is 1.6. New Hope is down about 20% year to date on a trailing dividend yield of about 13, and a trailing P of 3.4. And now this one is a bit crazy. Yancoal is down about 20% year to date and is trading on a trailing dividend yield of 27% and a PE of 1.7. Now with Yancoal, that said, its free float is under 20%, so it does affect the result a little bit. But what do you make of this? And why have you picked coal stocks as the stocks of the week?
Well, coal stocks had some pretty big falls this week, and that was on the back of falling coal prices. So I think they reached a peak of around about $400 a tonne last year or early this year, it might have been. And they're now back down to around about $140 a tonne. So coal stocks copped a decent battering. And I've got Whitehaven Coal in my portfolio. I bought that, I think around about the $1.50 mark. So it's done very well. Took some profits on the way, but still holding on to it because I think this is really, really interesting because traditionally you look at whether it's coal, commodity stocks, and when they look cheap, you sort of tend to think, the way it works in commodities is when the PEs are really low on commodities, then that's when you sell. When the PEs are really high, that's when you buy. And I think from memory, when I initially bought and recommended Whitehaven for my subscribers, I'm not even sure it had a PE because it was losing money. So that's when you buy them because they are such cyclical industries. Now you're looking at, and you had some trailing numbers before. I've got some forward-looking numbers for these stocks. Won't give you the numbers for Yancoal because I think maybe one analyst is covering the stock or not even any analysts. It just doesn't have much of a free float for that to happen. But these are on financial year 2024 numbers for Whitehaven, and they've been downgraded 44% over the past 6 months. So the consensus forecasts have come back considerably. But even so, it's trading on a PE of 3.2 times. The yield is 9.5%. It's on a price to book of 0.77 times, and it's got a return on equity of nearly 25%. So if you think those numbers are going to be hit, then Whitehaven Coal is an absolute bargain. It's worth a lot more than what it is now. And if you look at New Hope, similar situation. Its EPS forecasts have been downgraded 52% from the peak in September 2022. So at that time, analysts were forecasting FY24 numbers up here, and now they've curtailed them down 52%. But even so, the PE is 4.3 times, the yield 11.4%. It's price to book of about 1.5 times book, and it's got a return on equity of nearly 37%. So again, very profitable, very cheap, and using the old rule of commodities, they're sells.
Well, I've got a Peter Lynch quote here for you, just to sort of encapsulate what you were saying. I think in one of his books he said, "Buying is cyclical after several years of record earnings, and when the PE ratio has hit a low point, is a proven method of losing half of your money in a short period of time." So that's something to consider there.
Well, that's just been proven with the coal stocks over the past 6 to 12 months. Actually, I'll just share my screen and we'll have a look at the charts of some of these coal stocks, because I think it proves Peter's point pretty well. Got Whitehaven Coal here, and if I look at, it's peaked roughly October 2022. And we've got a share price decline of nearly 50%. So there you go. Peter was spot on, 52%. It's broken through this level of support here, and now it's approaching this next level of support. So Whitehaven Coal down considerably. This is New Hope. That's broken through this level of support here just this week as well. And what's that down? It's roughly down. That's about 36% down, so not quite at the 50% level, but not far off it. And then Yancoal, that's fallen sharply as well, broken through support. It's down roughly, again 36%. So they've all fallen significantly from their peaks. But here's where I would like to offer a low probability counter, because arguing against Peter Lynch is clearly stupid. So I don't really want to be too forceful in my arguments on this. Let me just stop sharing for the moment. Okay, so Whitehaven Coal, New Hope Coal, they produce coal. It's a commodity, and that the share price at the moment is anticipating a fall back to long-term traditional levels, which on the face of it is probably a smart bet. Where I would like to diverge from that bet is in the consideration of this net zero movement. And in my mind, as much as you'd like to say otherwise, I think coal is actually going to be in use more over the next couple of years than not. And I think the predictions are, because we are investing so much into renewables, because we are shifting away from coal-fired power in the developed economies, therefore coal will be less used. And I just don't think that is going to happen. And if you look at India and China, especially as the two sort of emerging economic sort of powers, they are building a huge amount of coal capacity. Even Japan is investing in coal. And if you look at Germany, I think I mentioned this last week. I can't remember. I've mentioned this in a few different forums, so I'm not sure if I'm repeating myself. But Germany have tried to go or are going off nuclear, which is insane, but that's what they're doing. And in order to continue to have energy security, they're restarting their lignite coal mines, which is brown coal. Now, last year, the reason why coal went to $400 an ounce is because Germany was scrambling to get suppliers and priced out countries like Pakistan and Bangladesh and all that sort of stuff, and just ramped the price up so much to get their suppliers. Now, Europe was bailed out because they had a pretty warm or pretty mild winter, so they didn't need a lot of that gas and coal supplies they had built up. My contention is if you don't get another warm winter in Europe this year, or in the winter that we're going to enter into towards the end of this year, then they're going to need to buy more coal. And when you look at the demand for coal increasing anyway from your Indias and Chinas, in my mind, coal is going to be structurally higher in price than what it has been in the past cycle. So I'm not sure exactly what that means where the price sits. Like, no one can forecast where the price sits, but if I look at what the shares are pricing in at the moment, they are pricing in a return to normal cyclical things where, coal miners might lose money for a couple of years in the next few years. So what's not priced in is the fact that this move to net zero and the focus on renewables, people aren't realizing that coal is going to play a really, really important role in the next couple of years, because renewables just aren't going to do the job. And I know that's probably a controversial comment for a lot of people who have an ideological belief in renewables being able to power our cities and all that sort of stuff, but it's just not going to happen. Like, not until we have some sort of major breakthrough in technology, battery storage technology. Renewables just aren't going to do it. And that means coal will be in demand. But on the other side of the coin, you've got Australia, which has got some of the highest quality coal reserves in the world. And, it's only relative because coal is pretty bad in terms of its polluting impacts. But Australia's got pretty good coal quality, yet it's very difficult to get any more supply out of the ground because all the people that, want wind power and solar power to power our economies also don't want any more coal being mined. So you've got this sort of supply on the one side, increasing demand on the one side, lack of new supply on the other side, which is, to my mind, is going to lead to a structural change in the coal price in the same way that it'll do it for oil and other fossil fuels. So going back to the price, I looked at the forward estimates for, say, free cash flows for Whitehaven coal, even cutting those in. I think I cut those in half, so I reduced those by 50%, and the share price looks about fair value at the moment based on that 50% reduction. So from a share price perspective, it's in a downtrend. You don't really want to buy into a downtrend unless you see price hit support and find support at those levels. And Whitehaven, for example, which I follow a bit more closely than the New Hope, is nearing that support. So I'm keeping a close eye on that because I think there's probably a good buying opportunity. If it breaks through support, though, I probably have to reassess my contrarian take on that and think, well, maybe the structural forces that I'm thinking about aren't there. So while the share price's momentum is going against you, you have to sort of keep in mind that you're probably wrong, but also you need to sort of look at where the support's coming in and whether the market might be coming around to your view. And if it does, then I think it bottoms pretty soon around here, and I think we go back to quite possibly back to close to the all-time highs. So yeah, looking at this as another re-entry opportunity for Whitehaven in particular.
Yeah, well, we can revisit that maybe in a year or two and see how that plays out.
We'll certainly revisit it if I'm right.
Yeah, exactly. Okay, yeah, we'll sweep that under the rug if you're not.
No, we'll keep an eye on it. We'll keep an eye on it.
Yeah. And I think another stock that you sort of wanted to mention was Bank of Queensland, and I think it hit a 52-week low earlier this week after Austrac and APRA criticised its board for risk management failings. But I think, again, maybe a contrarian take, but you think maybe all of the bad news is already in the price and this could be a buying opportunity. And that's sort of, when you mentioned that to me earlier, it reminded me of Michael Burry, and I think people probably know him from The Big Short. He was played by Christian Bale. And years ago, Burry had a blog, and he wrote in his blog that his strategy was pretty simple. It was, I try to buy shares of unpopular companies when they look like roadkill and then sell them when they've been polished up a bit. So do you think Bank of Queensland right now looks like a roadkill that can be polished up a bit?
Quite possibly, but let's have a quick look at the chart just to sort of give viewers an idea of what's happened to it recently. So it's looking pretty ugly there.
Yeah.
So from the peak, which was reached back in October 21, so around about the peak of the global markets, really, it's fallen 43%, and it's back down to levels it last reached when it was recovering from the COVID crisis, so back in October 2020. And as you can see there, it's sort of roughly, I wouldn't say it's a strong support level, but it's an interesting level of support where the buying has started to come in. So from a contrarian perspective, I think it's definitely a stock that you could have a look at. And just on the number, I think that the tricky thing with banks is they are very leveraged businesses, right? So if there is something wrong with them, it can go pear-shaped really, really quickly. So if I look at the forecasts for Bank of Queensland, and this is just using consensus forecasts for 2024, they've fallen, those forecasts have fallen 20% from October. So generally you tend to, if EPS or earnings per share forecasts fall by 20%, you can essentially look at a share price and say, okay, that's fallen 20% because the earnings have fallen. Here you've had a share price fall of 40-odd% while the earnings have only fallen 20%, or the earnings forecasts have only fallen 20%. So that means the multiples on this stock have contracted quite sharply. And if you look at the PE, it's trading on a PE of 8.9 times. It's on a yield of 7.9%. Price to book is only 0.56%. So it's just trading over half of its book value. But it's only got a return on equity of 6.45%. So it's a pretty poor return on equity, which suggests, like if you compare it to, say, Commonwealth Bank, I think Commonwealth Bank's got a forecast return on equity of about maybe 13% or something like that. Yeah. So it's nearly twice the level of Bank of Queensland. So when I run these numbers, and I've got a valuation model that takes into account return on equity, takes into account the dividend payout ratio, and also the main thing you've got to put into your model is your discount rate. So just for transparency, I put in a 10% discount rate for Bank of Queensland. And essentially that just means that if you're a business owner, if you own this bank and it doesn't trade on the stock market, then the combination of earnings through dividends or reinvested back into your balance sheet growth should give you 10% a year. And if you want 10% a year, then that will determine what share price you pay to get that 10%. So when I put those numbers into my model, it actually comes up to exactly where the share price is at the moment. So what is priced in? What's priced in is a pretty poor earnings outlook for Bank of Queensland. And when I say pretty poor, that's assuming a 6.5% return on equity. So if Bank of Queensland can get its act together and increase its ROE back up to, say, 10%, then this is a really good buy at the moment. But if I look at the consensus forecast for the next few years, that's not priced in at all.
Yeah.
So at the moment, as much as you would sort of look at this and say, okay, is this a good contrarian bet? I would say not yet. And what I tend to do with these situations is say, look, these moving averages here, this is the 50-day moving average and the 100-day moving average. When a share price extends well below those moving averages, it can often bounce back up to them. So when something's in the headlines and it's bad news and everyone's like, oh, embarrassed to hold this stock in my portfolio. I'm getting out of here. Everyone dumps it. It gets extended, and we'll have a quick look at the RSI, which is a bit of a momentum index. It's been oversold for quite some time. It bounced up here a little bit, fallen sharply again. So it's in this oversold region as far as a momentum indicator goes. It's probably due for a bounce, but I would probably want to see this stabilize for a number of months and start to see upward momentum return before I got interested, because as I said, banks are tricky. It's in a slowing economy. It's competing against the big banks with bigger balance sheets. And there could be, a number of headwinds for some time to come for this stock. So, contrarian one to put on your watch list, but you'd want to see evidence of stabilization of earnings, certainly a stabilization of the regulatory issues that it's facing. And I think with what you just mentioned, the Austrac and the APRA stuff that's occurred this week, that just suggests that, maybe management aren't particularly razor sharp there in looking at those issues. So you want a bank, and look, Commonwealth Bank trades at a premium to the other banks because I think its franchise and its management team is so well regarded. And when you don't have that in a bank, which is a leveraged institution, then that can lead to a discount being applied. And I think that's certainly the case. And that'll probably be the case for quite some time with Bank of Queensland. So, if you want to buy it for a lucky bounce and roll the dice, sure. But, it's not based on the outlook. It's certainly not particularly undervalued at this point.
Yeah, and I think with the management comment, you just have to look at Silicon Valley Bank and see what bad management can do to an institution.
Exactly. Yep.
Yeah. Well, I think now I'd want to move on to a segment that's sort of the heart of the show, and it's the what's not priced in segment. And I want to quiz you on what you think is the biggest idea that the markets are maybe overlooking and certainly not pricing in as much as they should. And I think I'd maybe want to start with China and the outlook for commodities in general, because definitely we've been getting quite a lot of bad press from China with their sort of softening economy, and the macroeconomic readings from China haven't been as strong as expected. So what do you think is being priced in there and what hasn't been priced in there?
Yeah, I think that's really interesting, because for the last couple of months, it's all been about China reopening, and they're going to, demand's going to come from the reopening story, because that's just what happens when economies reopen. And that probably happened to a certain extent, but that has certainly come off the boil in the last few weeks, few months, really. But this week, I think it became a little bit more of a story. So perhaps, again, I'll share my screen and just show some charts on this China story, because I think it's quite interesting when you look at some of these correlations. So first of all, I'm just going to show you the Shanghai Composite Index. Now that's actually been holding up okay. The all-time highs back here from February 21, again in September 21, and then a lower high here in December 21. So we've gotten through obviously a decent bear market there, but it's holding up reasonably well. And if I zoom right out here from way back when, it's sort of holding this long-term trend line, which is, looks like a reasonable rate of growth. So very volatile market, but it's not a disaster by any means.
Yeah.
But then if I look at the Hang Seng Index, that's not looking particularly strong at all, which effectively is just now an outpost of China. So that's looking really, really weak. And this is the Hang Seng China Enterprises Index. That's obviously quite weak as well. And the fall into the October low, which is when global stock markets bottomed, that was quite sharp. It's bounced from there, but rolling back over again. And really that low goes all the way back to 2008. So, that is not a good looking chart at all. And then let's look at some of the commodities. This is the copper price. So copper, well known that it's been under pressure the last couple of months, and that's sort of, moving into a downtrend there. If I might just zoom in on this, when these moving averages cross over to the downside, it just, in my model, confirms a medium-term downtrend is in place. This is the oil price. This is Brent crude. This has been in a downtrend for a significant amount of time. And this is I just need to change. This is the iron ore price. And that's been rolling over the last couple of months as well. And then finally, the Aussie dollar, US dollar exchange rate. And often, traders will look at this as a proxy, Australian dollar as a proxy for China, as a proxy for global growth. And it peaked back in February, late January, February, and it's been rolling over ever since and starting to head back down towards these lows. So to me, that rally was based on, China's going to reopen, good for global growth, all that sort of stuff. And then when China did actually reopen, it was clearly in the price when it was in the news. But when China did reopen, it started to sell off again, and it's now back down, towards those lows from last year. Just while I'm on it, another couple of charts to show you. This is the iron ore price overlaid with the Chinese renminbi and the US dollar. So this is the black line here is the yuan US dollar exchange rate, and that's been falling. And you can see the correlation with the iron ore price there. And there's also a decent correlation very good correlation, I should say, between the yuan and the copper price. Now I'm just going to go back and show you
those correlations are really, really strong, especially in recent years.
Well, they are, and I think it just shows you the impact that China has on certain commodity markets. But if I look at the momentum index, this is called the RSI. This is a short-term momentum indicator, and the Chinese yuan has been in the oversold area for quite some time, for nearly all of May. So to my mind, so there's two ways to look at this. So it's all been in the news this week, China slowing down, China's problems. And I think we even toyed with the magazine cover indicator showing, was it Peak China?
It was Peak China. Yeah, The Economist, yep.
Economist magazine had a Peak China magazine article. So that sort of, from a contrarian perspective, you say, okay, well, maybe it's not all that bad in China. And a lot of this short-term bad news is priced in. So what I'd be looking for in the next couple of weeks is probably a bounce, at least from these levels. And that would mean a bounce in iron ore prices, a bounce in copper prices, and some money coming back into our resources sector. So I think, to stick with the premise of the segment, what is priced in is a lot of worry about China and a lot of concern that China's peaked and China's going to slow down, and what effect of that is that going to have on resources. But what's not priced in is the fact that China might not be all that bad. I mean, it's still a massive economy. It's still growing. I was listening to an oil analyst just recently saying that even though there are concerns about the China reopening, they are still consuming records amounts of oil. So I'll just stop sharing that screen. So there is a lot of reason to think that, it's not as bad as what the market is pricing in. One thing from a longer term perspective that is not priced in for commodities is the push towards net zero. And everyone over the past few months, maybe even longer, has been talking about the need for critical metals, the need for copper, the need for aluminium, the need for all these strategic metals to facilitate this transition to a new energy system. None of that is priced in at current prices. And I think the market is very much focused on a short-term outcome, and the short-term outcome is a slowing global economy. Fair enough. And might have mentioned this in the show last week, but when hedge funds want to hedge against a slowing global economy, they will sell commodities. They will sell industrial commodities. And when I say sell, they'll sell paper futures or something like that. So the way that they can get exposure to or profit from a global slowdown is to sell futures, and whether that's oil futures or copper futures or whatever it might be. So it has an effect on these short-term prices, but the underlying physical supply and demand picture is still quite strong. So what's not priced in is the fact that the economy will recover. The politicians around the world will still go headlong into trying to build new transmission systems and new energy systems within the next 5 or 10 years, because the world's going to end if they don't. And none of that is priced in at these levels. So if you've got a longer term view, and when I say longer term, I guess that depends on, many different definitions of it. But I would say if your view is 1 to 2 years, then buying at these levels probably makes sense. But having said that, all those commodities are in downtrends, and buying into downtrends is always a risk, because they can just continue. So I would sort of probably suggest scaling in, whether you do that sort of on a monthly basis, or whether you just want to wait until you see some price support coming in and buying into the uptrend. But I certainly think from a longer term perspective, a lot of the bad news is certainly priced in the short term, but from the longer term, all the good news, a lot of the longer term good news isn't priced in.
Yeah, and I think for investors, when you see prices falling so sharply and everyone's sort of saying, oh, the economies worldwide, it's a gloomy outlook, it takes a bit of courage to sort of say, well, on a 5-year basis, this is actually a good buying opportunity. So it does take a bit of guts to sort of go, no, this is a good buying opportunity. I think one of our editors, James Cooper, he has been saying that, long term, especially for copper, this does offer good value at the moment. But I think we'll move on to the second.
Just quickly on that one, Kirill. Yesterday, I sent an update out to our Alliance members, who are our readers of nearly all our products, and we manage a model portfolio for those readers. And I sent out a message saying I'm adding 2 of James's copper producers to the model portfolio, purely because copper had been in the news in a negative aspect for some time. And I thought all that negative is probably in the price now, so it's time to add some copper exposure to the portfolio. So it is difficult in Australia because there's not a lot of pure copper miners here, and but James has dug out a couple of smaller ones. One's on the cusp of developing a project. It's got a good management team, and another one has got a very solid bunch of ground. And as a geologist, he's covered a lot of their drill results, and he thinks there's a pretty good project there. So we did add a couple of those stocks yesterday as well.
Yeah, and if anyone's interested, they can just check out some of James's writing. I think he writes for Farrell Commodities. But I think you spoke about something that was negative in the press. I think we've been hearing negative stories for weeks on end about the whole debt ceiling and whether or not the US is going to run out of money. I think in the last few days, that negativity has turned to optimism. Hooray, they've finally done a deal. It looks like it's going to pass the Senate. But I think you were saying that there's actually something that the market is not really looking at, and that's to do with short-term liquidity. And so, maybe just talk on that.
Yeah, so what's been happening since the government hasn't been able to issue more debt is that they've had to run down their savings, I guess. So they've actually had to perform like a household.
Yeah.
They've been constrained. And they hold those savings with the Federal Reserve in an account called the Treasury General Account. And that's been run down for, I'll show you a chart in a minute, but essentially the way that works is when the Treasury issues notes or bonds or whatever into the market, it takes liquidity out of that market, and then it either puts that money into the Treasury General Account or the government just spends the money straight away. So when the Treasury General Account is rising, it's taking liquidity out of the market. When it's falling, it's adding liquidity or adding spending back into the economy. So with that in mind, I'll just show you this chart, if I can find it.
Yeah, while you find, I'm just going to quickly read something that Bloomberg wrote. And I think, the concern is that with a tentative deal pending, the Treasury will soon replenish its cash balance by selling more than $1 trillion worth of bills through the end of this quarter. And I think right now the US cash pile currently sits at about only $39 billion, and that's been the lowest since 2017. So there's definitely a gap to fill there.
Absolutely. And this chart shows how low the Treasury General Account has gotten over the last couple of weeks, and new numbers just came out this morning, actually, I think. So it's up to 48, let's say 50 bill, but it's very, very low in the context of where it's been. So just to give you an idea, when the sort of corona panic hit, the government started issuing huge amounts of bills and bonds, and increased its Treasury account balance with the Fed Reserve hugely. That acted as a liquidity constraint on the market. But then when it started to spend that money back into the economy, and it ran it all the way back down here. So when did the market peak in the US? I think the market peaked in about November 2021. And this decline, or this injection of liquidity and spending into the economy, I think was a huge impact on that 2021 bubble that we went through. And then it's increased, taking liquidity out of the market again here. So that was throughout the start of 2022, and markets were under the pump during that stage. And then it's added liquidity and spending back in throughout this time. So what you were talking about then is that now that the government is able to issue debt again and increase its debt ceiling, it's more than likely going to increase its account balance at the Federal Reserve again, which is going to be a liquidity constraint on the market. So it'll be taking liquidity out of the market. Now, depending on how much it takes out, if it was a few hundred billion, it may not be that big a deal. But the fact that you're seeing banks slow down, you're seeing lending slow down, you're seeing the US economy slow down, then it could have a pretty decent impact. And even though this is sort of reasonably widely known amongst, I guess, financial professionals, I'm not quite sure how much the market has really priced that in. I don't think the market's really pricing in the impact of a potential liquidity withdrawal on the market over from the financial markets in the next few months. So that's a negative to keep your eye on, that might impact. And perhaps it impacts the large stocks that have been benefiting the most from liquidity over the past few months.
Yeah, and I think a final big story that's not priced in and sort of relates to this is a threat to corporate earnings. And I think you're of the opinion that the market isn't really pricing in a recessionary hit to profits and what that might do to forward multiples. Maybe you can talk about that as well.
Yeah, so I looked at, and this goes back to the conversation we had earlier about the index versus individual stocks. So these are EPS forecasts, or earnings per share forecasts, for the S&P 500 as a whole. And as you pointed out, there's probably about 10 of those stocks that are probably doing well, and 490 odd are struggling. So these EPS forecasts are wrapped up amongst 500 stocks, and maybe it's just a small amount of them contributing to this. But in general, the consensus forecasts suggest that earnings for the S&P 500 as a collective group, operating earnings, will bottom in the current quarter that we're in. So they'll bottom, in the June quarter, and they're going to start growing again from Q3. So at the moment, there's the EPS forecasts are suggesting a 5.8% quarter-on-quarter increase in earnings in Q3, and a 3.1% increase for Q4 on Q3 earnings. So we're bottoming now, and we're going to come out of this. And earnings have been falling in terms of growth, and have actually gone negative recently for nearly the past 12 months. So the market is pricing in a recovery in earnings starting from around now into the second half of this year. And then in 2024, over the course of that year, EPS growth is forecasted at 11.4%.
Okay.
So in my mind, given the lagged effect of monetary policy, that what's not really priced into those earnings is the fact that the Fed is going to keep rates high, and that lagged impact of tighter monetary policy is going to continue to flow through and impact the market well beyond this quarter, and probably into 2024. And you have a market pricing in, what is it? I think the PE is about 18.6 times on forward earnings. So it's not cheap. And if the earnings recession is continued, and you see analysts downgrading earnings from here, I think the market struggles to stay where it is. And I don't think the market's pricing in this lagged impact of monetary policy and the fact that it is going to have an impact on company earnings for longer than the next couple of months.
Yeah. Do you think that the market is sort of almost priced to perfection right now, and then anything it doesn't even would take a disappointing result, like a tiny disappointing result, to sort of topple the whole thing down?
Yeah, well, certainly the tech titans are priced for perfection.
Protection.
Protection. No, they're not priced for protection. So anything that comes out of left field on that front could lead to a significant sell off. And in those charts, remember from last week's show, I showed you those charts where you have tech stocks going into a bubble, they sell off, and then they react again and get towards those all-time highs before selling off again. I think that's a potential impact that can happen. And just to give you a sense of how much that is in the price, in the community, my daughter plays tennis. I took her to a tennis lesson last week, and the coach asked me, he drives a Tesla, and he said, my Tesla shares are getting better. They had a terrible year last year. And I said, oh, yeah, I know. But I didn't want to tell him how terribly overvalued they remain.
Yeah.
But he also sort of said, do you use AI at work?
Okay.
And so, it's the equivalent of the taxi driver mentioning
exactly.
Yeah. So I thought, I don't know how much better this can get. And going back to what we're talking about with the EPS earnings, I'm not sure, given that we've got high interest rates, we haven't talked about real yields. We can maybe do a show on real yields in the future, because they do have a big impact on how all this stuff's priced. Real yields are still quite high, which just tells you, financial markets are tight, monetary conditions are tight. And, if these companies do continue to grow earnings, then they're taking their earnings off someone else rather than, being a part of a ever-growing pie. I think the pie is shrinking a little bit, and there's a fair bit of fighting going on about who gets what in that pie. So, but the S&P 500 is a pie, and that pie is shrinking. So I think that's not priced in.
Yeah, well, definitely, if your tennis coach is talking about AI, you definitely should conclude it's priced in.
I think so. It'd be a fair assumption.
Yeah. And I think with the those consensus estimates, I was actually looking at some research a few years ago by GMO. They published a quarterly about price to sales, and historically, stocks that have price to sales of over 10 have actually underperformed the market. And I think with stocks like Nvidia, its price to sales is probably over 25. So that's something to keep in mind. That said, I think that research did conclude that on average, most stocks that are trading over 10 PS have underperformed, but there are some exceptions. So the AI bulls will probably say, well, Nvidia is one of them. It's going to be selling.
Well, if you're long, you always hope there's an exception.
Exactly.
But it goes back to what we were saying last week about it's just so hard to maintain huge returns on capital and be able to reinvest and compound those returns beyond a few years, because they just get competed away. I mean, unless these companies are genuinely monopolistic in almost a natural monopoly, in that they've built a network, it's too hard for competitors to catch up, because they have to do 20 years of research and investment in order to catch up. So unless they've built out these natural monopolies that can't be competed away, then you're right. You're going to underperform buying at these levels.
Yeah. And I think with a stock like Nvidia, it's still it's selling chips, and that is a bit cyclical. In all of those semiconductor companies have gone through massive peaks and also massive troughs, so that's something to keep in mind. But I think for me that's been very useful. I think that probably wraps up everything we've wanted to say. We've gone over an hour, but maybe I would just want to ask you any final takeaways that you want the viewers to have. What's the biggest thing that's not priced in? Yep.
You know what I'd like to show? There was a couple of charts that I had based on your comments earlier about the about the concentration of the US market. So there's just a couple of charts here I want to quickly show to take away. This is the advanced decline line. It's actually the advanced decline volume line. So it takes the number of advancing stocks and the volume of those stocks versus relative to the number of declining stocks with the volume included. And generally, that should be track the S&P 500. And as you've seen in the last couple of months, so roughly this would have been the sort of March panic with the Silicon Bank issue. You've seen that break away and the advanced decline. So the number of stocks actually falling and now starting to outpace the number of stocks that are rising. And the S&P 500 continues to march higher. So that's often
a huge
sign of
discrepancy.
divergence. Yeah, it's a sign of divergence, and that's a warning sign to say that, how long can this continue before it catches up with the rest of the internal market that's indicated by this line. Second
just
chart,
briefly, has there? With that first chart, when has that diverged like that historically? Has that ever happened before? If you can extend that graph further out.
I'm sure it has, but when you graph it further out, because the scales are so different, it moves. So you need to graph them in, I guess, probably a couple of year segments. But yeah, look, these things happen from time to time, and it doesn't always mean there's going to be a crash, but it just means that it might be a catch up to where the rest of the market is. Similar situation for this chart. This shows the number of stocks in the S&P 500 that are above their 200-day moving average. And again, it's a pretty decent correlation with the S&P 500, which is in red. So you could say from this that the internals of the market peaked on the 2nd of February. Now, if you remember back to that Aussie dollar chart I showed you, that also peaked in February, in early February, late January. So there's a lot of correlations here to suggest that this was roughly as good as it got for the global economy. And then stocks started to sell off from here. And it's, the number of stocks that are above their 200-day moving average in the S&P 500 are declining while the S&P 500 continues to hold up. And the last chart I want to just show is, this is the NASDAQ, which is a small bank index, shows a lot of regional banks. Obviously, that was the Silicon Valley crash. But up until then, the S&P 500 has tracked this small bank index pretty closely. And that, to me, suggests that, small banks are the credit creators, the small business, they provide credit to small businesses in the US, and they're very well correlated to the economic situation in the US. And the S&P 500 generally follows that. But since that's happened and the money's rushed into tech, we've seen another divergence there. So, I just thought they were interesting charts to leave you with to sort of back up the point that you made, that this concentration in the market has got to a point where you probably need to be a little bit concerned. But on the other side, if you're invested in stocks that have got, are not tech and are not really related to those big concentrations, you should be okay, apart from the fact that, it will impact sentiment. If the S&P 500 falls 10%, then the Aussie market's going to fall as well. But it's not necessarily going to impact the intrinsic value of a lot of these other stocks that have nothing to do with concentration or money piling into ETFs and stuff like that. Yeah,
those charts were fantastic. And I think what you were just saying, it's, again, I'll repeat it because it's worth repeating. It's always a market of stocks, not a stock market. And always ask yourself what's not priced in. But I think, what were you going to say?
No, nothing. I was just going to say we have been rambling on for a little while now, so we probably should say thanks for listening. And,
thank you for listening. Make sure to like and subscribe. And leave any comments, leave anything that you maybe want us to discuss. And maybe that should be the motto of the show. Remember to always ask what's not priced in.
Exactly. Nice one.
Thanks for joining What's Not Priced In, your weekly source of unique ideas in the Australian stock market. Now, if you've enjoyed this episode, please show your support by liking and subscribing and turn those post notifications so you don't miss a thing. And stay tuned for the upcoming episodes as we delve into new topics, new trends, and new stocks. Thanks for your support. Hope to see you next week.